In the year 2000, a premium burger at a local diner cost about $2. Today, that exact same burger, the same beef, the same bun, and the same calories, costs closer to $6. When you look at the bill, it is easy to assume you're the victim of corporate greed, or companies secretly colluding to raise prices. The physical burger on the left hasn't changed, but the currency you use to buy it has. This visual shows the reality. The burger isn't necessarily becoming more valuable. The dollar bill has simply lost its value over time. This is inflation, a phenomenon where the rising prices of goods and services over time reduce what your money can actually buy. If you are holding your wealth in liquid cash, you aren't just staying still. Your purchasing power is being eroded every day. These price increases result from four specific, trackable economic drivers. The first is demand pull. Imagine a market where consumers consistently buy 10 tons of corn, but a massive tornado destroys the crop. With only 3 tons left, buyers enter a bidding war, pulling the price upward to secure what remains. Next is cost push. If that same tornado makes raw corn more expensive, a popcorn vendor's profit margin disappears. To stay in business, they have to pass that increased production cost directly to you. Then there is the wage price spiral. When living expenses rise, workers demand higher pay. To cover that new labor cost, corporations raise the prices of the products those workers make, creating a continuous loop of price hikes. Finally, there is monetary expansion. When a government floods the market with new stimulus paper, you have more cash chasing the same amount of goods. Merchants react to this excess liquidity by raising prices. This reckless cycle of printing annihilated the economy of modern Venezuela. The currency lost value so quickly that citizens swept worthless stacks of cash into the street gutters because the paper was worth less than the ink printed on it. Flooding the system with more paper does not create more wealth. It simply destroys the trust in the currency itself. Institutions track these shifts using the Consumer Price Index, or CPI, a statistical tool that monitors the cost of a standardized basket of everyday goods. The flaw in this system is that it averages the data. High price spikes in essentials like bread or eggs can be hidden by flat prices in luxury items, making the official inflation rate look much lower than your actual cost of living. If inflation erodes your savings, why doesn't the government try to make everything cheaper? Falling prices, or deflation, is often worse. If consumers expect prices to drop in the future, they stop spending today. This causes corporate revenue to collapse and lead to mass layoffs, which was the primary catalyst for the Great Depression in the 1930s. The other extreme is hyperinflation. In Weimar Republic Germany, prices rose so fast that money became a toy. You had children playing with massive blocks of worthless cash because it was cheaper than buying actual blocks. To prevent these extremes, the Federal Reserve adjusts interest rates, the cost of borrowing money. Lowering rates encourages spending to jumpstart a slow economy, while raising them makes borrowing expensive, which cools down rising prices. A 2% annual inflation target keeps capital moving and businesses hiring, even if it means the cash in your pocket loses a fraction of its value every year. Central banks prioritize this growth momentum over the long-term value of your savings. Because the economic system is built on this constant 2% decline, holding your entire net worth in a traditional bank account guarantees a loss of purchasing power. Protecting your capital involves moving it into yield-bearing equities and hard assets, like gold, which can scale in value as the dollar weakens. This 10-year chart tracks $1,000. Bob's equities grew significantly. Jack's gold rose moderately. Tony's 1% bank yield barely moved. To find real yield, subtract inflation. Adding a 2% inflation dragline, Bob and Jack stay ahead. Tony's column falls into the red. Tony didn't lose his money in a market crash, but his purchasing power still decreased. Because he couldn't beat the rate of inflation, his $1,000 can only buy what $900 could a decade ago. Inflation is a constant reality in the global economy. Staying ahead of it requires a shift in strategy, moving from passive saving to active capital allocation.